Welcome to this month's Market Update. I'm here again with Alexandra Veroude, Senior Member of Frontier Advisors Capital Markets Team. Hi there, Alexandra.
Hi, Wayne.
Well, the first month of a new financial year, it's been an interesting one. Maybe let's start by stepping through some of the outcomes for international equity markets over the month of July.
Sure. So, the beginning of the new financial year brought a month of cautious optimism across global equity markets. From Wall Street to Shanghai, investors responded to trade developments and economic data with guarded confidence. US equities gained more than 2% over July, with broad-based gains across sectors as well as the tech sector. Equities have been buoyed by resilient, sound second quarter earnings and progress on trade talks. In the UK, gains were stronger but confined to a handful of names, while in Europe, gains were only around 1%, with financials continuing to perform strongly while consumer stocks struggled. In Japan, investor sentiment was upbeat despite domestic political noise and ongoing uncertainty around trade. But Chinese equities, in fact, had one of the strongest months of the calendar year, gaining nearly 5%, with sentiment boosted on productive trade discussions with the US towards the end of the month. While no major breakthroughs were announced at this meeting held in Stockholm, discussions signaled a willingness on both sides to stabilize relations and avoid further escalation.
And so, keeping that focus on China, there was a group of senior Chinese officials that met during July. What did we learn from those discussions?
Yeah, so the Politburo held their meeting at the end of July, and this was an opportunity for the senior Chinese policymakers to announce any new stimulus if they saw fit, as they set out their policy objectives for the second half of the year. No major stimulus measures were announced, and this is because we've seen GDP has in fact exceeded the 5% growth target in the first half of the year and has allowed greater scope for slower growth pulse in the second half. So this outcome was largely expected by markets. But policymakers said that they would sustain the current policy intensity, but quicken the pace of government special purpose bond issuance that is already in the agreed fund. And this is used to support local investments and industries of focus. Officials said that they would increase policy intensity when needed, and this is because we're still seeing the household sector remain subdued and is weighed by the overhang of excess supply in the property market.
So, some good signs from global markets and some interesting signals from our major trading partner in China. So, how did Australian equity markets respond during the month?
Yeah, so in Australia, equity gains were driven by the resource sector, with major producers boosted by iron ore prices rallying on supply disruptions, tightening global supply, and expectations of robust demand. Broader market sentiment has been supported by expectations of additional monetary policy easing. The Australian dollar was slightly weaker against the US dollar, but stronger against other major currencies, with commodity strength supporting. We saw the US dollar was back in favour on resilient economic data and the Federal Reserve maintaining its cautious stance and keeping rates on hold.
So, turning now to bond markets, what were some of the outcomes there over the month?
So, bond markets showed subtle shifts in July. In Australia, we saw the 10-year government bond yield rose by around 10 basis points as the Reserve Bank held rates steady and commodity prices firmed. This weighed on bond indices, while corporate bond and bank bill indices performed better. Meanwhile, the US 10-year Treasury yield edged up slightly, which reflected a mix of economic resilience, inflation concerns, and fiscal dynamics. As I mentioned before, the Federal Reserve kept rates on hold once again in July, and this caused a strong reaction from President Trump, once again blaming the Fed chair for unnecessary economic strain. The president's comments reinforced this ongoing tension between the White House and the central bank, even as Powell reiterated the Fed's commitment to data-driven decision-making and maintaining independence. However, markets are looking towards a rate cut at its next meeting in September, reinforced by this softening labour market data.
Well, data-driven decision-making and independence, something we hold dear at Frontier, of course. So a great start, really, for investors to the beginning of this year. Plenty ahead. We look forward to having you take us through that as it unfolds. But thanks for this month's analysis, Alexandra. And thanks for watching this month's Market Update.